Hello there, my property people. It is your favorite agent, Kanye, the property guy. We're back with another exciting episode. Now, today I'm sitting with an accountant, a chartered accountant, Adrian. Adrian, say your surname for us.
Quina. It's Adrian Quina.
Yeah, that's a different surname, eh? Quina. How are you doing, Adrian?
I'm all good, thanks. I
Yeah.
can't complain.
Yeah,
That's good.
yeah. No, thank you for joining us, man. Adrian, tell us a bit about yourself. Like, where did you grow up? What made you become an accountant?
So, just a bit about myself. So, I grew up in Nice. So, I'm originally from Knysna.
Okay.
So, I moved through to Cape Town at about 5, 6 years old. And I stayed in Cape Town for most of my upbringing. So, what led to me deciding to pursue accounting? It was actually just the passion that I had for business. So I always saw business owners sort of as superheroes because at the end of the day, they're the ones that are solving problems within society. So they're creating convenience when there's a need for convenience,
Yeah.
or a lot of solutions, or even employment. That's also a superhero in itself. If you think of someone that's unemployed, they have very little hope, very little means to create a better life for themselves.
Yeah.
But now the business owner is the person that sort of brings you into his system and allows you to express yourself and to create value and take care of yourself.
Yes.
So because I always looked at business owners as superheroes, then I just fell in love with business studies in high school. I fell in love with accounting, and then that's sort of what led to me deciding to study chartered accounting in university.
Okay, I
Yeah.
got you. I got you. You see, I love the fact that you're saying business owners are superheroes. Well, I tell my wife all the time that I'm a superhero, that I'm Superman. Yeah, so now I'm gonna play this clip for her. You see?
Definitely.
Yeah. So then you knew from that young age that you're gonna be doing accounting.
Yeah, so not actually. So when I finished matric, I did business studies, accounting, and bio in high school.
Okay.
And then I actually enrolled at university for this marketing, BCom marketing or BCom law.
Yeah.
Because I knew I wanted to go into business, but I didn't know what the best course was for me to reach that destination.
Yeah.
So when I went to UCT, they have mentors that they assign to you when you enroll, so they help you with your registration and things like that.
Yeah.
So I asked the mentor, so I told him that I want to go into like business eventually. What would be the best degree that would be a good stepping stone for me? So he suggested accounting CA stream because once you finish that, you can then do your articles at an audit firm. So now when you're auditing companies, you get to like study a company through and through. You get like a deep insight about the company. As opposed to if I was going to go to BCom marketing, it might take me time after graduation to actually find a company that employs me. And then if I do get that employment, it'd probably be limited to just sales and marketing.
Okay.
Whereas through audit, you get to learn like the entire business process, things like that.
I see.
So yeah, I was actually only at university where I decided, okay, let me do BCom accounting, and through discussions with the mentors and things like that.
Wow, that's wonderful. That's awesome, man. And then in your own life, would you say like who's somebody that you would say like you looked up to? And it doesn't have to be, somebody that was an accountant or whatever. But now since we're speaking about mentors in your own life growing up, who's someone that you think you looked up to?
There's quite a lot of people. I wouldn't say, I'd say definitely parents because of the sacrifices that they make.
Yeah.
So typically, in business also, you're not going to see the result immediately. You have to sort of lay the foundation, sacrifice a lot.
Yeah.
So you get to see like an enduring benefit like after some time.
Yes.
So I think definitely parents like early on when they would sacrifice a lot,
Yeah.
maybe like for to ensure a better future for myself.
Yeah.
Yeah, at their expense maybe. So definitely I'd say parents was a good were good superheroes for me at the time.
Wow, man, that's a great answer. It reminds me of a time. This coffee is making me hot now. It reminds me of a time when a few years back we went for interviews at another job. I think I was like 19, so it was during my gap year.
Yeah.
So we go for these interviews at this job, and then like they tell us now, after like it's a group discussion now, group interview.
Yeah.
Now they ask us, who are your guys as role models and stuff, and who do you look up to? And my friend was there with me. My best friend Mandisi was there with me. So everybody were going around, people like, Jay-Z, this person, 50 cents, blah, blah, blah. I forget who I named, but I named some big business person that I
Yeah.
admired. And then comes Mandisi, and then Mandisi says, my father. I'm like, yes, this guy makes us all look bad now. Why didn't we think about our parents? Now this guy. because he was the person that I've seen put in the hard work.
Yeah.
He's my father, he said. It's like that guy, his father rose in the company from being a cleaner to being like one of the managers at the top, like executive.
Oh, that's impressive.
From being a cleaner to being like
Sure.
one of the executives in the company.
Yeah, so I think then as a child you get first hand experience to see like the sacrifices that they made and the
Yes.
work that they put in. Whereas a lot of the times the idols that you see on TV, you won't see the process, you only get to see the end result. So it's difficult to
Yes.
resonate with their stories
That's
all the
true.
time.
That's true. But like, so what you just said now made it remind me of that. I was like, yes. Because really, when I think about it, I'm like, why would you choose all these people that, like you're saying,
Yeah.
that you don't know their process? Like, I'll tell you, my mother. My mother graduates from matriculates when she's 22 years old. Now, to give you a comparison, when I was 22, I was graduating from varsity.
Yeah.
So she's matriculating at 22 years old. At 25, she has me. At from 25 until the age of 33, 8 years, she is she's doing this and that, selling clothing, all this stuff. She's just trying life, right? At 33 years old, she decides, at that age, I'm going to grade 1. So I'm just about to turn 8. I'm going to grade 1. I'm studying grade 1. She decides to go back to varsity. 33 years old.
Sure. And a lot of the times people think that's too late, but
Exactly.
to have the willpower
Yeah.
to dedicate yourself to that.
She at that point, she has 2 kids now. Because my sister has just arrived and she decides to go back to varsity. 4 years later, she becomes a teacher.
Oh, that's
And
impressive.
I always I always point how my life has turned out. I pointed to her because like when after she had graduated and gotten a job and all these things, she then with my father had a conversation. Hey, we can afford better now. Let's move out of the township. All these things.
Yeah.
So like them moving out of I moved out of the township when I was like 14 years old. Us moving out of the township has given me, I think, well, I don't think I know, such opportunities in life. Because when we sell people real estate, a lot of the times what we always forget, because a psychologist says the most important thing for your child is environment. That's what a psychologist say. So like it's the environment children grow up in. Now, your environment is not just the home itself, but it's outside of the home. Yeah. So the area, what happens in the area, all the stuff. Because environment plays such a role in someone's upbringing. Yeah.
True.
So I attribute everything, all the opportunities I've had in life to my mother going back to school.
True. Because that definitely puts you in the right position.
In right position, put me in such good situations and all this stuff because she made that decision to go back to school at that age.
True. Because
Life could have turned out differently if she hadn't. You
because if
see.
you think about it, the friends that you'd have in the suburbs would be different from the friends that you'd have there, which would have influenced a lot of how you think.
Yes,
like
yes, yes. And like there are a lot of kids who come out of the townships that do well. I've had friends that come out of township was all fine, but I just think like I know for a fact if I didn't come out of the environment, there are certain opportunities that I wouldn't have had.
That you were exposed to.
Yes, that I was exposed to when she decided to come out. Yeah. Yeah.
Okay, no, that's impressive story.
Exactly.
Yeah.
Yeah, so that's what I was supposed to say when I was 19. My mother.
Yeah, no, I can definitely resonate with a lot of what you're saying because also in high school, when I started reaching matric, I also became very close with friends that were doing very well academically. So they actually inspired me or gave me the belief that I can be a top 10 candidate. So before then, I was actually like an average candidate.
Yeah.
So at the high school that I used to attend, they used to tell you position in the grade on your report. So each end of term, they'd say you came 50th in the grade or the 60th. So that was my positions, like say grade 8, grade 9. And then as I became acquainted with friends that are like top achievers, I started accelerating as well. So then at the end of matric, I eventually ended up like top 10. So that just goes to show like
The
The type of
power,
friends that you,
yes,
yeah.
yes, the power of friendship, the power
Mm.
of friendship. And that story now got me wanting to preach now. Let me not start preaching. All right, let's go into some of the discussions that I said we'd speak about. Some technical stuff now.
Yeah.
Some technical stuff. I get a lot of clients who are business owners, right? That they are self-employed. So, what are some of the benefits of registering a business? What are some of the disadvantages of not registering a business? Because a lot of them, they don't want to register a business because they don't want to pay the tax man.
Mm.
Yeah.
Yeah.
So can you just elaborate on that?
Okay, so there's quite a few aspects that you have to look at it from. So I would definitely say first you'd have to look at it from the perspective of your customer or your potential customer. A big corporate might only engage with you if you are a registered entity. So they're not going to necessarily engage with a person that doesn't have a registered company behind them.
Mm,
Let's say, for example, if you do business with a big corporate, they have a whole vetting process. So they want to see your registration certificates
mm,
and all those things. So if you decide you don't want to register a company, you're potentially losing out on that market.
mm,
For instance, you can't get a tender with the government
mm.
just trading as yourself.
Yeah.
So you need to have some sort of entity behind you.
Yes.
That's one component, like the business that you could potentially get or not get.
Mm,
Another component is also funding.
mm,
There's a lot of funding opportunities out there, but in order for you to qualify for most of that, you need to be a registered entity.
mm.
They're not going to just deposit the money into your personal bank account.
Uh,
Yeah, so
uh,
you miss out on potentially customers, funding, and then another one of the very important aspects to look at
mm,
is risk.
mm,
So if you are trading as a sole proprietor, so
mm,
you're not a registered entity, you're just conducting informal trade.
mm,
If there's, let's say, something goes wrong and a client sues you or supplier sues you, they can go after any of your personal assets. So there's no
mm.
separation between you and your business.
Okay.
So if you have a nice car or a nice home and a supplier or customers unhappy
Mm,
and there's damages, they can go after your personal assets for the damages
mm.
because you and the business are one.
Okay.
But if you're a registered company, then you too. So you got the
Mm,
company and you got you. So if
mm.
the company incurs damages
Yeah.
and there's lawsuits, they can only go after certain assets within the company, but they
Mm.
can't go after your personal assets.
I see.
So it's the risk as well that you're mitigating.
Okay, okay.
Yeah.
And then okay, now you've answered both those questions then. Then for somebody to register a company, right? Is that process, is it a big process? Is it how?
No, no, it's a fairly simple process. So you can get it done within a week.
Mm,
So it's a two-step process.
mm,
So step one is you go via the CIPC, so
mm.
you get a registered company, registered name, everything like that, so that you can do it in a week.
Okay.
And the next step is now SARS.
Mm,
So once you have a registered entity, now you need to appoint yourself as the public officer
mm,
with SARS, which is basically telling SARS that, hey, you're the director of this company, you're
mm,
responsible for the compliance of this company.
mm.
And that process takes about 21 business days.
Okay.
So you could say about the entire process is about a month to get
Okay.
everything up and running.
Okay.
It's really simple. As
And
long as you,
costs
sorry,
and costs.
so it varies per service provider. So if
Mm.
you're doing it alone, it could cost you, I think, about 200 rand if you clued up on
Okay.
how to go through the relevant channels.
All right.
It costs you as low as 200 rand or
Mm,
maybe less.
mm.
But if you go via sort of different service providers, it could cost you about 1,000 rand,
Okay.
about there. Yeah. But
Okay.
then remember, there's also additional add-ons. So you might want a tax clearance right after you register your company. You might want a tax certificate, not a tax certificate, a share certificate and
Mm.
things like that, which is like add-ons, which
Okay.
could bring up the bill quite a bit. But I'd say
Okay.
about give or take 1,000 rand.
Oh, okay, okay, okay.
Mm.
That's not too bad. That's not
Mm.
too bad.
And as little as 200 rand if you know how to do it on your own.
Oh, I see. I
Yeah.
see. If you just want to wing it, I see.
Yeah, but
Mm.
there's also a risk with that. Yeah.
I see. All right.
Yeah.
I think a lot of the people listening, they just gotta wing it. They gotta like, I can save 800 rands. It's fine. Okay. All right. So let's go in my field now. Uh, Now let's say the person is registered now.
Yeah.
They are self-employed. They have their own business. Would you say it's better for them to buy a property using the business, or they must buy it in their personal name?
So it depends. Is it like their primary residence or is it
Yes,
for
primary
investment?
residence.
Oh, primary residence, they definitely would be a good idea to buy it in your personal name.
Okay.
So from a tax perspective, let's say later on in life you decide to move homes and you
Mm,
decide to sell your old home.
mm.
If it's in your personal name, you get a primary residence exclusion, which means any profit that you make on that home up until a certain threshold is not taxable. So SARS gives you that relief. It's a primary
I
residence
didn't know
exclusion.
that.
Yes, whereas
Ah.
if it's in a company, since a company can't necessarily reside at a primary home,
Mm,
it doesn't get that primary residence exclusion. So if it sells at a profit, it's going to be taxed on a profit
mm.
for primary residence, whereas the individual wouldn't,
Oh,
up until
okay.
a certain threshold.
Okay. All
Yes.
right. That's awesome.
But if it's like investment properties and you want
Yes.
to grow your portfolio,
Mm.
then it makes more sense to go via a registered
Entity.
entity. Yes.
Okay. There was a video. Now that we're speaking about this, there was a video that I wanted to send you, but I just didn't get a chance. So anyway, somebody. Okay, but it's gonna take us away from what we're talking about now with my business people. We'll come back to it.
Okay.
There's somebody who was saying, right, that they rather prefer financing their properties rather than buying their properties cash. And he was speaking about in the sense of tax of SARS. So now I don't. He's not speaking about like primary. He already has a home,
Yes,
but
yes.
now for investment purposes. So can you just shed light? If I finance my home, is it better from an accounting perspective to finance it, or is it better for me to buy it cash if I have the money to buy it cash?
So you have to look at it from two perspectives.
Mm.
If you, let's say, for example, if you,
Sorry. I'm gonna be getting a rental income
yeah,
from this. Yeah, yeah,
okay,
yes.
yeah. So there's two perspectives that you can look at it from. So let's say, for example, if you're going to use that 1 million as leverage, right?
Mm.
You could potentially invest in multiple properties if you put, let's say, 20% down on each property.
So 200,000.
Yeah, so you can
Okay.
have multiple properties.
Mm.
So you have the leverage, right? And you're financing it compared to going cash in the one. So
Mm.
then you
One
only have
million
the
cash.
one. Then you only have the one versus potentially, let's say, three or four or five if you
Mm.
leverage it.
Mm.
That's one economic side to look at it from,
Mm.
and the other side is from a tax perspective you mentioned. So there is a deduction
Mm.
that the SARS does allow you. So the interest that is charged by the lender,
Mm.
SARS allows you to reduce your taxable income by that interest expense.
Okay.
Yeah, so that means effectively you'll be paying less taxes
This
because
is if you
if
buy
you finance, if
in
you
or you finance it.
yeah, if you
Yes.
finance, then remember, like let's say for example, if you finance a property for about 20 years,
Mm.
you'll make total let's say the property costs you 1 million rand,
Mm.
you'll repay about 2 million in total.
Mm.
So half of that would be the principal, the million, and the other half
Yes.
would be the interest over
Okay.
time. So basically, from a tax perspective, SARS allows you to reduce your taxable income, your
Mm.
profit, by the interest over the years. So you're paying a
Okay.
lesser interest
All
or
right.
lesser tax bill than what you would have if you went all cash.
Okay. Okay. Oh, that's awesome. That's
Yeah.
awesome. So now we're speaking about, because I normally say when I speak to people around real estate, you get two types of people um, with that are like buyers of properties or owners of properties. So you get somebody, which is every most 90% of the people out there, or 80%, that buys a property. It's a primary residence,
Yeah.
and then they're gonna work. They don't have time to buy a secondary property and all this stuff, right?
Yes.
They're gonna buy this property. They're gonna pay it for 20 years. This is there to raise their family. Clear.
Yeah.
That's 80% or 90% of the
Yeah.
people. Then you get the second type of person, which I call these ones. These are ones that are playing the property game. They are players of property. These
Yeah.
ones, yeah,
Yeah.
yeah, yeah. So whenever I speak, I think I sometimes lose my audience where they don't know who I'm speaking about. You
Ah,
get what I
because
mean?
it's two different
Because there's two types
people.
of
Yeah.
people. So for instance, I was speaking about renting versus buying a home.
Mm.
And where we were discussing, then people were saying, no, if you finance a property, then you're not owning because blah blah the bank. You know that
Oh
old
yes,
saying.
yes, yes,
Yes,
yes.
yes, yes. But now the person I'm saying that they should not be renting, but they should be financing their property and paying a bond, is the first type of person. The
Uh,
one who's not gonna be buying a secondary property or a
yeah,
third property.
yeah, yeah.
That's who, because if for instance you're renting 6 years, that's a 6 years that you could have been paying a home loan
Mm.
where you could have built equity in that to do other things, whatever, all the
Yeah,
stuff, right?
yeah.
Rather than throwing money in the bin through renting. So now, in what you just said now, I think you're speaking about the second type of person, which are the guys that are playing the
Yeah,
property game.
yeah, yeah.
Now let's take just a bit about with these guys that are playing the property game. How does it work if I'm doing rentals now? The guys, actually, let's cover both of them.
Okay.
Let's cover both of them. Let's say the person A, he has a primary residence, he has a second property where he has units
Yeah.
that he's renting out. This person, how does the taxes work for him?
Oh, okay. So from a tax perspective, he's essentially running a trade
Mm,
because he's providing a service, which is the accommodation that he's providing,
mm,
and in return for that, he's getting an income.
yes.
So he could then, because he's conducting trade, he could either conduct trade through himself as an individual, so
Mm,
as a sole proprietor,
mm.
or he can register a company and conduct trade through the company.
So he also would need to register.
It would be up to him
Ah,
depending on, like I mentioned, those three aspects that you need to look at is needed for your customers, do you need it for funding,
mm,
or is it beneficial from a risk perspective?
mm.
And then also the tax rates differ.
Okay.
That's one thing I
What are we
forgot to
looking at?
mention. Yes,
Yes,
yes, yes.
yes.
So maybe I could just go deeper into that point.
Okay.
If he's renting the properties via a company,
Mm.
the profit that he gets from that is taxed at a flat rate of 27%.
Okay.
So that's corporate tax, it's flat at
Okay.
27%. If he's renting the properties via a sole proprietor structure, right?
Mm.
So it's in his personal name, then the tax rate is dependent on where his level of income is. So let's say, for example, if he's making very little income from that rental trade, he could pay almost 0% in taxes, right? Compared to if he's earning millions from that trade, he could pay as high as 45%.
Wait, when you say millions, is it calculated on a yearly
Yes,
basis?
per annum. Per
Okay.
annum.
Okay.
So let's say, hypothetically speaking, if he's only generating profits of 200,000 per annum,
Mm.
you could pay 0% of that profit over in taxes, meaning you pay zero taxes.
Okay.
But let's say if his profit is, let's say, a few, let's say 10 million, you could pay close to 45% of that profit over in taxes.
Okay.
So it's a sliding scale depending
Yes.
on how much income or profit you're making on that deal or trade.
Okay.
Whereas with a company, it's fixed at 27%.
That's what that video was saying that I wanted to send you.
Yes. Oh,
That's what it
yeah,
was
yeah,
saying.
yeah.
You know
So,
that video?
no, no, but that's a crucial element that I
Yes.
missed out earlier on when I
Yes.
looked at
That's what the
those
video,
things.
because you are speaking about 45%. Yeah.
Yes, it can reach as high as 45%.
Okay. If you're making that. Okay. Now it goes back now to this point that I was making now. That guy in that video, I think, was speaking about the type B person that I explained, that is playing the property game now.
Oh, yes, yes.
Yes, yes, because this guy, the type A person, who is just maybe built this property or flat here just to supplement his income.
Oh,
He doesn't have plans to be like a property investor and all this stuff. It's
mm,
just to supplement, to have a second income for his
oh,
job, right?
oh, yeah, yeah.
Yes. Now let's speak about the type B person.
Oh, so, oh, what structure would be best for the type B person then?
Yes. Now
Oh,
somebody who wants to grow
oh,
and have
one,
a property portfolio and all this stuff, right?
oh,
So obviously they would need to have a company in
yes,
place.
yes, because
Yes.
it would open up doors as far as funding,
Yes.
funding, and also the tax rates. Because if you're gonna have more income over time, you're gonna be paying tax at a higher rate if you're trading as a sole proprietor,
Mm.
because it's a sliding scale.
Yeah.
Whereas if you're trading as a company, it's gonna be flat,
The flat 20,
regardless
yeah.
of how much profit you're making. So
Okay.
if he's playing the property game, it's his business.
Mm.
Definitely going the company structure,
Mm.
because it's gonna make raising capital easier.
Yeah.
You can get investors, you can
Mm.
buy shares in your property
Yes.
company. You can't buy shares in someone's personal name.
I got you. I
Yeah,
got you. I got you.
yeah.
Okay. This the guys that are playing the game now. When you mention funding, what type of funding is out there for people in that space?
Okay, so there's the National Empowerment Fund.
Mm.
So they a empowerment organization. So
Mm.
they support PE, so black ownership.
Okay.
So you could go via them, just depending, because they also support a lot of township and rural empowerment. So if you're going to
Okay.
develop in township or rural areas, that's what they're going to support. That's part of their mandate.
Okay.
Then there's also business partners. They
Mm.
support a lot of real estate investments, but they're more looking at develop to sell. So
Okay.
not the develop for rentals and things like that.
Okay.
Then there's also Bidprop.
Mm.
So with them, they would take a lot of the risk upfront.
Mm.
So they'll do a lot of the development, but then they'll exit after, I think it's about 10 years, they exit, and then you have all the equity
But
of.
they are the ones that take from the rental like 80%, right?
Yes, yes, yes,
Okay,
yes.
okay,
So they essentially have a big stake of the equity for
okay.
the first 10 years, but
All
then they
right.
exit the investment and then it's all yours.
Mm.
And then the other one that I mentioned earlier,
Mustandi.
yes, yes, yes,
Okay,
with them. So they support a lot of township or entrepreneurial property development.
okay,
So they have certain target areas that they look to empower entrepreneurial investment as
okay.
far as real estate.
All right.
So like in Cape Town, it would be like areas like Mitchell's Plain, I think Kalicha, areas
Okay,
like that.
okay. No, I got you. I got you. Since we're speaking now about the property investment and all these things, there's a term that floats around that people like myself who you would call the layman, right?
Yeah.
We don't really understand it. Explain to us capital gains tax.
Okay. So firstly, there's one principle that you need to, and that's a tax concept.
Okay.
So heading into that, there's one thing that you must first understand. When you acquire an asset, it
Mm,
could either be stock, which is revenue in nature. So stock would be like, let's say you a retailer and you're buying, let's say, houses, you're flipping houses.
mm,
That would be revenue in nature because it's part of your enterprise. That's what you do.
yes.
You trade in homes, so you buy and sell homes.
Mm,
Then there is capital homes. So these are homes that you intend to keep for a very long time. So
mm,
more than a year, 5 years, a decade,
okay.
something like that. So you can, if you're in the business of flipping homes, right? Then you won't attract capital gains taxes. You'll just be taxed normal. Like this is your stock. The house is like your trading stock,
Mm,
and you apply a markup, and then you sell it, and then you make a profit.
mm,
There's no capital gains tax on that because
okay.
it's treated as stock, like how Shoprite would treat a loaf of bread
I
or something.
see.
There's no capital gains tax on
Okay.
that because your business model is to flip. So
I
it's
hear
part of
you.
your
You get
business.
it and you sell it.
Yeah,
You
yeah.
get it,
So
you sell it.
so it doesn't attract any
Yeah.
capital gains tax. So because it's revenue in nature,
Mm,
when your intention is to hold it for an extended period of time, and you're not flipping, you're holding it for quite some time, then it's capital in nature.
mm,
So then the moment you then sell it, it will attract capital gains taxes. So what capital gains taxes is basically, it's like the profit on that disposal.
mm,
So let's say, for example, if you have a home that
mm,
cost you, let's say, R1 million,
mm,
and you sell it for 1.5,
mm,
the profit on that is 500,000.
mm.
So that's the capital gain, the appreciation that you would
Yes,
have
okay,
realized.
yes.
So
So
the
how?
calculation then for the individual, as far as capital gains tax would be, let's say you make a gain of 500,000 on a property,
Mm,
the inclusion rate from a tax perspective would be 40%.
okay.
So only 40% of that gain is considered for the purpose of calculating your tax liability.
Mm,
And then your tax is calculated based on what tax bracket you're in.
mm,
So if you're in the 20% tax bracket, then that is the percentage. So the full formula would look like 500,000, which is the gain, multiplied by 40%, which is your inclusion rate, multiplied by 20%, which is the
mm.
tax
Okay.
bracket that you're in.
Okay.
And then as far as a company, the formula changes slightly
Okay.
because for that same gain of, let's say, 500,000, the inclusion rate now changes from 40% to 80%.
Mm,
So you can see, because the inclusion rate goes up, that means SARS is now taxing you on a bigger piece of the gain.
I
So you're going
see.
to pay more taxes on that capital
I
gain.
see.
But then the effective tax rate is 27%.
Mm,
So, well, not the effective tax rate, the tax rate is 27%,
yes.
which means irrespective of how big or small that gain is,
Mm.
they're going to tax you 27% of that.
Okay, I got you. I got you. And then you mentioned that capital gains, it must be you must have hold the property for a certain period. Is there like a minimum period that SARS says that it must be maybe a year, 2 years, 3 years?
So actually, SARS doesn't necessarily look at the duration per se. They look more at the intention of the seller.
Okay.
Um, yeah, so how it works is the onus is on the taxpayer to prove why an amount is taxable or deductible or so forth. So basically, the onus is on you to justify the tax treatment. Let's say, for example, you're a flipper, right?
Mm,
Which means ordinarily your homes that you sell wouldn't attract capital gains taxes. but now you have this one property that you can't sell, or it's a struggle to sell it. So it takes you maybe a year, 2 or 3 years to sell it. You can still make an argument that that property was always still a revenue in nature, so it was never capital in nature, meaning you still don't have to pay capital gains tax on it because your business model is such that the homes that you own are revenue in nature, not capital in nature. So irrespective of the period that you hold it for, it's still not going to attract capital gains taxes. So the
Because
own
of my intention.
yes. So you have to prove your intention to SARS basically.
Mm,
So the onus is always on the taxpayer to prove why an amount is not taxable. Yeah, but
okay.
SARS can assess you and say, hey, we're going to charge you capital gains tax on that. But you can always come back and prove to them why you qualify to be excluded from capital gains taxes.
Oh, I see. I see. Okay. So we must argue our case.
Yes, that's why you'd have an
Ah,
accountant or a tax
okay.
practitioner on you
Hey,
because they
look, he's
would.
plugging himself. He's plugging. I'm gonna put his number here. This is where you get Adrian, the accountant. He's plugging himself. I saw you there.
Yeah, so they would be familiar with the tax legislation. They
Yeah.
would know what relevant sections are applicable,
Mm,
case laws, things
yeah.
like that. So they would know how to justify your case for you.
Oh, okay. No, I got you. I got you. So you get an accountant so they can fight for you. You hear that? Don't be stingy, guys. Pay the money. In order to make money, you must spend money. That's very true in my business, guys.
Yeah, most
Okay.
certainly.
Adrian, I think we're going to my final question now, right? We started with self-employed when we started the conversation. Now I want to wrap up with self-employed again now. And I think we are going to need a second session. We're going to need a part two with Adrian, the accountant. But let's wrap this one up. So self-employed, let's go back to self-employed. People that are self-employed wanting to buy properties uh, in their own name or with pay slips, with banks and all the stuff. Like, can you explain to us how they can navigate that?
Okay, most certainly. So if you're going to finance the property through a bank, so the biggest risk for the bank is if we do this deal with you, are you going to be able to pay us the money back that we gave to you?
Mm,
So if you have a stable job and you get a fixed salary each month, it's less risk for the bank that you not be able to pay.
mm,
So then in that case, the bank might just need your pay slip to prove that you're earning income and
mm,
look at your bank statements over the last 3 to 6 months to see what your expenditure is. And then based on that, they'll then conclude whether you do qualify or not.
mm,
But now the tricky part is if you're self employed, then your income goes up and down, up
mm,
and down.
mm,
It's not fixed.
mm,
So now the concern from the bank's perspective is would you be able to pay us back in your worst month?
mm,
Right. So how they then assess that is based on how much income do you make in a year,
mm,
and on average, what is your minimum income? And
mm,
based on that, can you be able to pay us back on this loan that we're giving you?
mm,
So then, in order for them to make an informed decision, they look at um, one, two, or three things, depending on which institution you go to.
mm.
But most of the time, it would be your annual financial statements.
Okay.
So annual financial statements are what they would ask you if you're operating through a company,
Okay.
because a company, in terms of the Companies Act, is required to produce annual financial statements
Mm,
each year. If you're trading as a sole proprietor, which means you're not a registered company, you're just trading informally or as a sole proprietor, then you're not required by law to produce annual financial
mm,
statements. But they still expect you to do accounting. So you need a record of accounts in the form of management accounts,
mm.
which is a summary of, let's say, it includes a profit and loss, which is a summary of how well you would have done in the last 12 months.
Okay.
So it will say what your annual revenue is, your
Mm,
income, what your expenses are, and
mm.
what your profit is.
Okay.
And then they sort of look at that as what your salary would
Mm.
be. And then based on that, they can then assess if you would qualify for this loan and what your risk profile would be.
Oh, okay.
So then, just to conclude, most of the times they'd ask you for, depending on if you're a company or non-company, if you're a freelancer
Mm,
or you sole proprietor, they would
mm,
ask you for management accounts,
mm.
which is like a record of your accounting,
Okay.
and then also your last tax return that you submitted.
Mm.
So basically, they want to see that the income that you're presenting to them is consistent with what you're presenting to SARS, because
Oh,
because so that
I
you
know where you're
can
going.
yeah, because
Mm,
otherwise you might tell SARS that you're not making any money, but to the
mm.
bank you're telling them you're a millionaire, so they want to
Yes.
see that it's
Yes.
matching up. So that's one thing. And then if you're a company, then you do annual financial statements, management accounts, and also in some cases your last tax return that you would have submitted.
I
So they want
got
to
you.
see that you're not lying.
I
Because
got
a
you.
lot of the times people will submit no returns
Or to
when they do it to
SARS.
SARS.
Yes. Or when they want the money, I'm rich, guys.
Yeah.
I'm rich.
Yeah.
The bank, on that point that you said now, that the bank wants to know, even on your worst month,
Yeah.
that you'll be able to pay them.
Yes.
So people present themselves, they go to the bank. Even on my worst month, I'm the best.
Yeah.
Even on my worst month, I'm the best.
Yes.
No, guys, man, you must be truthful, guys, if you want money. But I understand it though. It makes sense.
Yeah.
Adrian, thank you so much for your time. We truly
Appreciate
do appreciate your time. We appreciate the insight. You've given us too much. You've given us a lot of information.
I'm
That's why
glad.
I think there's more to get from the well of information that you have. So we must make an appointment to do a part two in the
Oh,
later months. Yeah.
that would be great.
Yeah,
That would be great.
So I'm gonna put on Adrian's details here, his number, his email, and so you can contact him. And you make sure you tell him that I saw you on that YouTube of Kanya, that property guy. Make sure to tell him. So yeah, so tell me, Adrian, what is something that is your long term goal when you are 60 years old? What would be the best metric, yeah, to use whether you are successful or not in life when you are 60 years old?
It would be impact, like how many lives I've changed, like how many customers came through my doors and were happy customers and were able to grow their business or their ambitions further. Like how many people I would be able to take out of employment and upskill them and make them productive citizens, or how many people were able to witness my journey and were able to draw inspiration from my journey and then motivate themselves to also believe that they can achieve whatever their aspirations are. So yeah, I'll say more the lives that I can impact as opposed to any assigning a monetary value to it. So it's not like I need, let's say, 10 million to say that I've made it. It's more about the lives that I can change.
Yeah. Oh, that's beautiful. That's beautiful. Yeah. Thank you so much for your time. We truly do appreciate it. Kanya, your favorite real estate agent. Guys, make sure you subscribe. That's it. We are out. Property Talks. See you on the next one.